With the housing market in flux and the Banking Royal Commission in full swing, all eyes are on the lending habits of banks. Interest-only loans were once a magic pill for many investors, allowing them to enter the property market or increase their portfolio with little damage to their bank books. But the cheap days of interest-only loans are disappearing. Here's Rachel Pupazzoni.
Terry Unwin recently converted the interest-only loans on her investment properties to principal and interest, even though there's still more than 2 years left on the interest-only terms.
We looked at our budget and determined that we could afford the P&I repayments, and it meant that we were building equity in that property.
Terry's a mortgage broker, and she says many of her clients are now doing the same.
Probably in the last six to 8 months, it's become significantly more prevalent that clients will request to switch prior to the end of their periods.
The period is the agreed time a homeowner has with their bank before they have to start making repayments on their loan. Until then, they just pay the interest. It's most commonly 5 years. It wasn't long ago when there was little or no difference between the interest rate on an interest-only loan and the rate on a principal and interest loan. It led to a boom, and by 2015, 40% of all loans in Australia were interest-only. But it wasn't to last. The banking regulator APRA toughened conditions, putting a cap on the percentage of interest-only loans, which saw lenders put the squeeze on borrowers.
The lenders responded by increasing the interest rates for investment loans for existing and new borrowers.
The method worked. Just 15% of new loans issued now are interest-only. But there's still about $360 billion worth of interest-only loans due to mature in the next 3 years. That's against a backdrop of a sharp correction in property prices and falling equity for investors.
A whole chunk of people aren't going to be able to repay, and if they all need to sell at the same time, even if that's 20% of these folks, then that leads to a fire sale, and you see something looking scarily like what happened in the US circa 2008-2009.
Fears of a mass exodus from the investment market might prove to be unfounded because the tide is turning. Now, just like Terry, investors are likely to get a better rate if they cut out of their interest-only loan and move across to principal and interest.
What we are finding though is that as soon as those loans switch to principal and interest, we are negotiating significant discounts for those clients as soon as they start making the principal reductions. So the interest rates can drop by up to 0.6, 0.7, 0.8% immediately.
Australia's largest lender, the CBA, has just cut rates on some of its fixed interest products for homeowners and investors. The RBA says if you've got a good credit risk, you can save 15 basis points on your loan. There's also anecdotal evidence some banks are waiving annual charges and set-up fees to sweeten a move across. And that's exactly what many property owners are now doing.
We've been proactively contacting clients to encourage them to make that change, and some are contacting us before we get to them because they want to get their interest rate back down.
The Commonwealth Bank's decision to cut its rate, when commentators have long been hinting at rate rises, is likely to trigger a competitive response from the other big banks. But that may be small comfort for overstretched investors no longer able to depend on the days of easy lending.